Hey, I'm Ryan Reynolds. At Mint Mobile, we like to do the opposite of what Big Wireless does. They charge you a lot, we charge you a little. So naturally, when they announced they'd be raising their prices due to inflation, we decided to deflate our prices due to not hating you. That's right. We're cutting the price of Mint Unlimited from $30 a month to just $15 a month. Give it a try at mintmobile.com/switch.
New activation and upfront payment for 3-month plan required. Taxes and fees extra. Additional restrictions apply. See mintmobile.com for full terms.
Nothing can grow fast in the world lest it become the world. But we all forget that. We all think, oh, wow, this thing is growing so fast. It's so wonderful. Fine. But I would have said the same about Japanese stocks in the 80s. Would have said the same about tech stocks. I would have said the same about the Stutz Motor Company in 1928, which made the sexiest car on the road, the Bearcat. It was a magnificent machine. That company was broke 4 years later. It was the best auto in the world.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. In this episode, I'm pleased to welcome back investment specialist Julian McCormack from Platinum Asset Management. Hello, Julian.
G'day, Phil.
I'm always happy to chat with Julian about his unique views on investment markets. We last spoke at the end of March when markets were beginning their recovery, or actually maybe they were still on the way down at that point, but somewhere around there. And today is December 21, and US markets are making all-time highs with the ASX not far behind. So, Julian, let's talk about the year. How was it for you?
Well, it was a very odd year in a lot of ways, obviously, Phil. It was for everybody. From a strictly investment perspective, it's been an extraordinary year. And let's try and break that down a little bit. When we talked in March, what we said was bottoming is a process. It's scary. You don't know how low it can go. But having had a 30, 40% correction, you can begin deploying capital. And you might be down for another 18 months or something, but you've just got to turn that into a process. It's not a point. You're not trying to be competitive and pick the bottom. You're just trying to work capital in so that when things improve, you'll be happy about that in a couple of years. And that turned out to be sort of inaccurate in a way because bottoming wasn't a process. It was a point, and markets exploded up from that sort of late March point. March 23, I think, was the low. That is because of a whole series of factors. I mean, the first is liquidity. So what does that mean? It just means, basically, it actually means reserves in the banking system in a technical sense, but it really just means money.
Can we just break that down a little bit? Central banks, that's what's happening this year, isn't it? That central banks around the world are pushing money into the system. How do they do that?
So there's a few things going on within that. Narrowly to answer your question, I'll just restrict my comments to the Federal Reserve, which the mechanics of its operations I know reasonably well.
The US Fed.
Yeah, that's exactly right. And so what happened immediately, in fact, even prior to COVID, it actually began in late 2019. There was a few ructions in interest rate markets. And what Federal Reserve started to do was inject liquidity by doing a thing called a repo operation, a repurchase operation. And what that means is banks have a whole lot of government bonds, and that is offset in a direct mechanical way, like they're an offsetting account with their reserves. So if the bank wants to put more reserves into the banking system, it can buy their bonds from them, or in a repurchase operation, that they actually borrow them. And if they don't have enough reserves, it's the same as them not having enough cash in the system. Then they have to borrow that cash from someone else. It's a bit like getting caught short. When you owe someone some money, you scramble and it affects your behavior. So that was sought to be alleviated in the banking system. Then the other thing that central banks did was to buy bonds. And what that's doing is that's forcing rates down. It's putting cash into the pocket of whoever just sold the bond.
Are these corporate bonds or government bonds?
A bit of both. For the first time in the Federal Reserve's history, to be honest, there wasn't that much corporate bond buying. It wasn't in huge quantities. It was just the knowledge that it was out there that then adjusted the market behavior of participants. And that had a dramatic impact on market behavior. And so what happened was rates go down in a recession in a very narrow sense. They go down on government bonds, and they're often forced down by central banks these days, but they usually go down anyway because people want the safety of a guaranteed repayment. So they go and buy government bonds. So the price goes up and the rate falls. Everybody else's capital availability goes down and their rates go up, right? That's what a recession really is. in a modern sense. It's, oh gosh, I thought I had some capital available to me last year. Now, gosh, it's going to cost me 2, 3, 4 times the rate to borrow it, or I can't get a loan at all. Hello, you're in a recession. That's not what happened this year at all. Happened for about a month. Capital was forced into the system and lending exploded in a private sense and in that bond issuance, bond purchasing sense. Pretty unusual and also totally different to what happened after the GFC. So bank credit creation collapsed in the GFC. Remember, the banks were stuffed. So they weren't lending to anybody. And bond issuance fell dramatically. If the world had fallen apart in March and we were saying you want to commit a bit of capital to markets, and now markets are back at a record high, what does one's behavior have to be? It now has to be disciplined in the other way. So people really must be building cash or at least have something in their portfolio, Aussie bonds or Australian government bonds or US government bonds or whatever. That's not a terrible idea in this kind of environment, but it's probably early. I mean, these markets look like they just want to run forever. They won't, by the way.
They won't, but it is. It's really the whole psychology of this year has been so skew-if, but the markets just continue to keep on going higher and higher, don't they? And it's really just this liquidity, the amount of cash that you say is being put into the system, that's driving it.
It is, Phil, but it's a couple of different things as well. Sorry, and I didn't finish my thought earlier on. Thanks for reminding me that liquidity doesn't do all that much by itself. It needs to go along with a narrative. It needs to go along with a vibe, to quote the Castle. Yeah. And that story, I think, works in a whole, layer cake effect. The first is, oh, cool, the Fed's got my back. Central banks have my back. I can buy really without risk. The second is there are all these tremendous businesses that are sort of winner take all and will dominate the fields in which they operate. So therefore valuation doesn't really matter because the value of these things in 10 years' time will be immense. So present value, I'm not really that concerned. And then there's, a series of other sort of layer cake effects, so disruptors versus disrupted. And then there's a bit of an emerging, ESG, so environmental, social and governance driven investment and particularly environmental disruption and change. And all these things go together. And the classic example of this is Tesla. That company's done an amazing job, but it's now worth top 10 automakers in the world combined. It's never been profitable making cars.
And it's hitting the S&P 500 for the first time tonight, isn't it?
And it's in the S&P, yeah. And so what happened on Friday is a really good example. So that stock traded about 150 billion in a night, Aussie time. Microsoft trades maybe 5.
Mm-hmm.
Biggest company in the world trades 5.
Yeah.
and this did 150. So that's a whole bunch of things going on there. It's index participation, so forced buying by indices, probably a bit of speculation going on around that. And that just pings back and forward often. So you get this huge sort of volume.
Is it true that Tesla makes most of its money from carbon credits?
Yeah, it makes it from emissions credits, selling into the EU. So EU 2020 and the Chinese standard for average fleet emissions dictates the level of carbon that can be emitted per average car per kilometre. They're the two biggest auto markets in the world. So Europe does 17, 18 million passenger cars per year, and China does about 24 million. The States does 16 million. So all big markets, but the two biggest are saying, guys, you need to have this emission standard thing in place. If you can't, we'll fine you, or you can go and buy emission credits from another automaker who's accrued them somewhere. All of Tesla's cars obviously are electric, so they get this big credit and they can sell that, and they've been selling it to Fiat Chrysler. So the problem with that, though, is that goes away because all these automakers have all these models coming out that let them meet their emission standards, and so the value of those credits basically goes to zero in about a year.
Is that part of what you're talking about with ESG, how ESG is affecting the market?
Yeah, it is. It is. The ESG, environmental, social and governance standards are really good. It's not that there's anything wrong with it. It's contributing to a nonchalance around price that gets very bubble-like. And that's one of these narratives where people say, oh, look, I want to go and buy something that solves the plastic crisis, or, you know, something that gets rid of the use of crude oil or whatever. And so they'll probably go and buy a basket of stocks in an ESG fund or an ESG ETF. And so what you get is this real crowding type effect into stocks that are perceived to be winners in that regard. And then you get, you know, unanchored from price, and that's definitionally where you get bubbles.
One of the things that I've heard from other guests is that technology is something that's keeping inflation under control as well. That all of the advances, the dematerialization of goods, the way services are all going into the cloud, also have an effect on keeping interest rates down, and that we might have low interest rates for decades to come because of that.
It's possible. It's very possible. Inflation's an interesting thing. It's not very well understood. And when I say that, I mean central banks don't really have a good model of how inflation works. So that's a bit problematic. You know, people might have heard of a thing called the Phillips curve, which is an inverse relationship between unemployment levels and inflation. It doesn't seem to work. And then the other thing is, you know, it seems to work in regimes. You know, it seems to work in, you know, long, you know, decadal and longer swings. And we've been in a deflationary world, say, for 40 years. And it feels completely unrealistic that anything could change given the one direction things have been heading in for 40 years. What I think happens in human behavior in general, but certainly in economics and financial market economics, is expectations are formed and then they drive prices for long periods of time in a regime, and then something breaks the regime and then you get these big change points. It's entirely possible that's happened. But let me paint a different picture, which is we had the biggest financial crisis in 100 years, and we didn't just spring back to life after that. We had actual fiscal austerity in big economies that mattered all the way through to the Trump tax cuts late in the decade. So we had fiscal austerity in the middle of the recovery of a global financial crisis, not that helpful. Then you had the Europeans really shake confidence with the Eurozone crisis through to 2012. Then you had the Chinese wanting to tighten policy. That transition has happened, but it was very disruptive on the way through, and you had to correct for a whole lot of bad lending in China on the way through. And then you get a couple of years of, you know, feels okay. I mean, you know, things are back to normal, 16, 17, followed by global trade war, global pandemic. So people mustn't assume that we're in some baseline normal. We ain't normal here, folks. This is pretty weird. And so what is assumed about this is, the low rates and low inflation of this extended period of time, they're normal. They're here to stay. They're fine, whatever. Hang on, but let's just rewind those causal factors. Eurozone crisis over, China tightening over, global trade war over as of January 20, and coronavirus will be over in about a year, because we will have very widespread vaccine. And we have these massive government deficits now as well. So there's every chance we do get inflation.
Support for this podcast and the following message come from Corient. Corient provides wealth management services centered around you. They focus on exceeding expectations, simplifying lives, and establishing legacies that last for generations. Leverage their exclusive network of experts to help achieve your personal and professional financial goals. As one of the largest integrated fee-only registered investment advisors in the U.S., Corient has experienced teams who can craft custom solutions designed to help you reach your financial goals, no matter how complex. Real wealth requires real solutions. Connect to a wealth advisor today at Corient.com.
Yeah, this is why I was just trying to get to the point, is that you're saying that it's like a coiled spring. All of these forces are coiling up this spring with all this kinetic energy, which will be released in the form of higher interest rates. And higher interest rates are not good for stock markets. Is that correct?
Well, the rate question is really interesting, Phil, because I think basically the big central banks around the world are telling you, we're actually pretty cool with manipulating rates. So the behavior is saying we can buy rates along the curve wherever we want. And their language is saying we're very happy to tolerate higher than target inflation. You know, this symmetrical targeting regime that the Yanks are talking about is just saying, like, we've had a whole lot of time under 2, our target's 2. So we're very happy to take a whole lot of time over 2, because otherwise people's expectation will anchor to a rate lower than 2 and we want them to anchor to 2. I don't know if that makes any sense, but
You use the word expectations a lot.
it's basically what economics is.
Expectations. Yeah.
Yeah.
It's interesting that you use that word. Yeah.
It's basically what a price is, right? I mean, think about buying a house. It's such a consequential thing. You should buy a gumball, you probably don't care. But if you buy a house, if you stump up and bid on that house, you're actually making a statement about your expectations of your own and the area you live in and the society and all that. You're making a statement about its future. It's nothing to do with the past, because it doesn't matter what the house next door sold for. It matters what this one sold for, because you bought it and you owe the money. What you're stating is that I'm confident about my ability to repay that loan. I'm confident that the value of the house will go up. I'm confident that credit will remain available should I require it for refinancing, etc. All those things are embedded in the price. And so, yeah, that's why I refer to it so much. So, but just back to this rates versus inflation, Phil, that's even another factor to expect inflation to be not even just tolerated, it's actually being welcomed by central banks.
Mm-hmm.
In a total reversal of what independent central banking has been all about for its history, which has been about inflation targeting. Because remember, the whole genesis of how central banks work was that we had very spendthrift politicians who couldn't be trusted. And so we needed a central bank to offset the largesse of elected officials. For the last 10 years, central banks all over the world have been begging elected officials to spend money. And they're saying, we will be tolerant of higher than target inflation. And they're saying, look at our toolkit, guys. We can buy bonds. We can buy corporate bonds. We can buy sovereign bonds. We can buy them in all maturities. We can put unbelievable amounts of liquidity into the banking system anytime we want. What me worry? It's like the Mad Magazine thing. And that is the way out for central banks, is inflation. And there's this sort of mystery about inflation and what it is. But let me demonstrate with a crude example. If a monopolist puts a price up, the price stays up. If it puts it up repeatedly over time, that's inflation. And so what, the entire machinery of financial governance is pointing toward is higher inflation. Now, there's reasons why it might not happen. These are all contingent on what people do in the future around policy, et cetera, et cetera. But the way it looks right now, it looks pretty likely, pretty possible. Now, will that be some sort of runaway inflation like the 70s? No. We have this hugely financialized system. So even the hint of significantly higher rates has a much bigger proportional effect. Just think about household debt now versus in 75. You had to put a suit on and clean your teeth and whatever to go and get a loan, polish your shoes and act like a good boy or girl to go and get a loan. That's a bit different now. So we just got massively higher debt all through the system and much greater sensitivity to rates, which will adjust to inflation at some point, maybe with a lag. It's just that lag might be pretty significant and help reinforce that inflationary dynamic early on.
So are you feeling positive for markets in the new year?
No, I feel cautious about markets.
Okay, so I just want to go back to the point when we first started talking today. You were mentioning that people should be positioning themselves for some sort of, well, not necessarily a correction or bad times, but you feel that markets are in a bubble, I'm assuming, and that you should be putting some of your money into some sort of position to protect your capital. Is that the case?
Yes. I mean, the main part is have a little bit if you want. If you want to play, have a flutter, fine, whatever. But don't own the heat. Everyone who lived through 2000, and I did sort of peripherally, I was pretty young.
That was the tech
bubble
crash. Yeah.
Everyone knew we wouldn't see another regime like that, another situation like that, because it was so crazy. Everyone who I listened to or have the privilege to talk to who lived through that, invested through that, says this is way crazier, and I just don't know how it ends. Now, if you're just protecting your wealth for the next 20 years, just don't be there. There's not a lot of point being there in any meaningful sense. Certainly don't gear into it, and I wouldn't have too much of my wealth exposed to it. But if you want a little flutter, fine, go for it. I mean, whatever. But do understand that you're in a point of history where market cap to GDP, 10-year average price earnings, next 12 months price earnings, price to book, price to sales, they're basically at 100%, i.e. you've never been here before. So if you think this is a good time to buy stocks, you're almost definitely wrong. That's what that probability means. We've never been this expensive on a whole bunch of measures. There are wrinkles around that because relative to interest rates, maybe it's fine. But what have we just been saying about inflation? One must be cautious. That said, what is interesting about this is that the relativity of a whole bunch of assets that are cheap relative to things that are expensive have never been more extreme. So Europe's at an all-time low versus the States. Japan's at an all-time low versus the States. These are equity markets. Yep. China is just off its lows of all time relative to the States, but very close. All of emerging markets, which is dominated by China, to be honest, but that is very close to all-time lows versus the States. Materials and energy versus the States, all-time lows. Grains versus equities, all-time lows. And what have we been saying about inflation? There's a very strong chance that it might reassert itself. So there are lots of things to do if you're so inclined. I'd be very happy owning a whole basket of assets along those lines that I just said over, say, 5 years. I think that's going to make good money. Over 1 year, maybe. Because if things sell off, correlations all go to one. If everybody has to get out, they have to get out. A bit like we saw in March. Can anyone predict that? No. And the thing about this that I think maybe isn't very well understood is that these are non-deterministic processes and lots of life is non-deterministic. What I mean by that is it is not the case that if we just had a bit more information, we could work out exactly what will happen in the future. We just need more information today. We can get a better picture, but it is non-determinate. It is strictly non-deterministic stuff. So it is, like subatomic particles or, things called Penrose tiles or, there's all these instances of these things in real world events that are non-deterministic. So for a given state, I can't know the future state. That is absolutely true of financial markets. They're chaotic systems with billions of interactions. So what can we know? We can know the state of the system and likely outcomes. And the state of the system from like the 100th percentile evaluation, the likely outcome is bad.
Yeah, and it's interesting, though, that a lot of the time we're counselling investors to stay in for the long term. Don't sell off, just take a 5, 10, 20-year view rather than what's going to happen next week. How does this affect people who are now thinking, okay, they've got some money in the equity market, maybe for the first time? Are you saying they should be selling off right now?
Yeah. Look, I can't comment on people's individual circumstances nor advise them.
No, of course not. We can't be giving financial advice here.
But yeah, as a start point, have plenty of cash. Don't be geared into markets. Do not be geared into markets. Don't borrow to put into markets because it doesn't look like the right time to do that. The right time to do that was March when there's, blood in the streets. It's not now. And also do realise if you have a mortgage, you are leveraged long a financial asset. And so you're already geared into a market. So if you've got a mortgage plus you're sticking money into equity markets and you have no cash, you're very leveraged long, right? You're long residential property and you're long equities and you've got gearing into it to do it. So people's circumstances must dictate their disposition. But I think people should be cautious and they should have plenty of cash. The most important thing is avoid the heat. Avoid the stocks that have gone up 10-fold, 5-fold, that are trading on huge multiples of revenue, not even earnings. If you've got some of that and it's been good on you. Just remember to have some cash and don't have all of that be your portfolio. The core thing that people lose sight of always is that there is a baseline. Nothing can grow fast in the world lest it become the world. But we all forget that. We all think, oh, wow, this thing is growing so fast. It's so wonderful. Fine. But I would have said the same about Japanese stocks in the 80s. I would have said the same about tech stocks in the late 90s. I would have said the same about Chinese stocks in 2006-07. I would have said the same about mining stocks at about that same time. I would have said the same about tech stocks in 1967. I would have said the same about the Stutz Motor Company in 1928, which made the sexiest car on the road. Mm-hmm. The Bearcat was a magnificent machine. That company was broke 4 years later. It was the best auto in the world in 28. So it's the same thing in different clothing each time. And this iteration of it is different, but it shares all the hallmarks. In fact, it's a more exaggerated a more virulent version of that same type of dynamic over time.
At this point, I'd like to wish listeners a Merry Christmas. Yeah. Look forward to it with caution, not optimism, obviously.
Yeah, totally.
So just a little bit off topic here, because we've talked about in the past the disconnect between economies and markets. Is that still the case? Because, like you say, the Northern Hemisphere locked down, economies are seriously affected.
Yeah, there's a few different disconnects. I mean, one disconnect is temporal. So the current state of an economy isn't really what a market wants to price. They probably want to price the future state of an economy, maybe a year out. Who knows? It's all suppositional. And so are markets right to be a bit excited about what the world looks like post-COVID? Yeah, they probably are on some level. Trade war over, virus over, also simultaneous restart of economies. So all these economies growing very, very rapidly all at once. That's all pretty exciting. So yeah, that's fine. What doesn't get reflected in that though is what's the path to that outcome? So if we get some big hiccups with the vaccinations, if we get resistance to uptake of the vaccines, if we get serious distributional bottlenecks and can't get vaccines around fast enough, if we have a situation where, oh my God, these vaccines work for 4 months and we can't get enough people vaccinated before the first vaccinations wear off, so we can't get any form of immunity in communities, oh, sugar, we've got a problem. So there's all this risk to these outcomes. That's where the interesting part of market pricing comes in. Markets are never wrong, but they change. They're never wrong because I can go and get the price, right? The price is the price.
Yeah.
So that's not wrong or right. It's just that they change. And so people just need to remember, in February, it felt like COVID was a bit of a distraction. It really did. We took it pretty seriously, but even then we were like, oh, and then by the end of February, it was a global shock of really unprecedented magnitude, probably going back to the Black Death waves of the 13th, 14th, and 15th century. So that's a pretty good reminder. You can think everything's wonderful and all of a sudden it ain't. So there is a disconnect, but it's because markets are doing a different job than just reflecting what's happening in the economy. They're not doing that job. They're doing the job of assessing the probability of outcomes in the future, and they're different. That said, can I just make another brief comment? There hasn't actually been a disconnect between equity markets and the real economy, because what drove equity markets higher for most of the year were these big platform businesses that do very well out of COVID. Amazon does great out of COVID. You have to stay home and buy stuff online. Fantastic. And look at that versus like energy stocks or shipping stocks or banks, or that they're all hopeless for most of the year. So there wasn't a disconnect. What I think gets reflected to people is equity markets up, so therefore economy must be good. That's not what that means.
It's not the way it works, really, is it?
No, it's not.
So Julian, again, Merry Christmas, and thanks very much for coming on with a cheery Christmas message for listeners and the new year.
Well, thanks very much for having me. It's always a delight to talk to you.
Yeah, it's great to have you on. Thanks, Julian.
Thank you.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.
Acast powers the world's best podcasts. Here's a show that we recommend.
Hi, I'm Ceci.
And I'm Angela.
And we are the hosts of the Bravo Docket.
The Bravo Docket is a chart-topping podcast that you can listen to understand what is actually going on in the lawsuits that are making the headlines. Ceci and I are two practicing attorneys who take our experience and knowledge of the law and apply it to the lawsuits and legal issues involving your favorite celebrities.
Every hour-long episode covers the facts, the law, and the legal tea. People have questions and we answer them. From things like Todd and Julie Chrisley's sentencing to why a trending celebrity was sued. We use our knowledge and experience to help you understand what happened. We explain it all.
So check us out everywhere podcasts are streaming for facts, fun, and Law 101.
Acast helps creators launch, grow, and monetize their podcasts everywhere. Acast.com.